So this is going to be a talk about 3 papers in essence. So I've been starting to do research on this. There's some more papers I could even talk about. I'm going to talk about those 3. I'm only going to give you touch upon 1 and 2, and that gives me an opportunity to talk about cryptocurrencies in general. And some of you may be very familiar with this. If not, then hopefully you learned something. And then 3 is going to be that's going to be the equation part of the talk today. Right, so, okay, so let's jump in. So let's talk about Bitcoin first, right? So Bitcoin is the granddaddy of all the cryptocurrencies, the first one that was issued, and that's how it looks like. Well, actually not, right? I mean, you can buy these things in the store, they're beautiful, but that's not a Bitcoin, right? Bitcoin is electronic currency. It sits on your computer. Actually, it doesn't even sit on your computer. I mean, that's sort of part of the tricky issue there. But it's digital money. It exists in digital form, and in digital form only. So, and it really, it's a topic that came from computer science. So computer scientists have thought for a long time of how to create digital money. It's an interesting problem if you're a computer scientist. Right, so if it sits on my computer, right, then it's a Bitcoin there, then I send Martin, that file, and I say, here, I pay you, but I could keep a copy and then spend it again and send it to Georgios, right? So with electronic files, since they're easy to copy, you have this double spending problem. So how do you avoid this double spending problem? But at the same time, computer scientists, being the anarchic types that they are, right, they didn't want to have some central agency, keeping track of all the transactions. They wanted to have it decentralized. So they want to have somehow a decentralized ledger. So that was a problem. And computer scientists had held conference where they talked about it and so forth. Eventually, somebody came up with a solution. He said, here's the solution to the problem. A narrow set of problem, I would say, right? So he said, this is how it can be done. The intention was not that this is the best way of doing it, but just showing that could be done. And this was based on this paper by Satoshi Nakamoto, 2008. So he wrote a paper. It's not a complicated paper, by the way. And then put up some code, and the thing got up and running. I say he, but nobody really knows who he is. It might be she, right? It might be a group of people. It might be, Vladimir Putin and Trump together. It might be the CIA. We don't know, right? I mean, to this day, we haven't figured this out. There's some people that suggest it's a certain person, but it's still a secret. So let me describe, simply because it's a general audience talk, how it works, even though in the end, I'm going to abstract from all these technical details. As I said, I'm not an engineer, I'm not a computer technician, so I'm not interested in the inner workings of this, right? So I'm going to take a macro monetary perspective eventually and ask questions that I want to talk about. Okay, so imagine there's Alice, and she wants to pay Bob, some bitcoins, right? 0.5 bitcoins, let's say. Okay, so she just does this transaction, right, on her computer or on her app or whatever. And when she does that, that transaction gets then posted on the internet, literally, right? I mean, it's in some ways, it's the most public form of paying someone because the entire world knows about it, right? Except that, you wouldn't say Alice and Bob in this transaction, you would say account A to account B. So unless you know who is behind the accounts, you can't figure this out. But it's publicly broadcast, the transaction itself publicly broadcast. So then, then other people might also, publicly broadcast their transactions. So there will be transaction from C to D, I don't know, I just made this up, 1.2 bitcoins in E to F, 0.3 bitcoins, whatever. You have a list of pending transactions, but they're not part of the record, right? I mean, they have to be incorporated in the record. The accounts have to be settled, right? I mean, what you want is deduct 0.5 bitcoins from A and give 0.5 bitcoins to B, right? So there has to be public record, right? I mean, settlement of these transactions. Right now, they're just pending. And to settle them, you have these additional people that are called miners, right? So anyone can be miner, in fact. I mean, you can download the software for doing this. It's about 150 gigabytes, including the blockchain. Start running on your computer, and then your miner. I wouldn't recommend it for a variety of reasons, but if you just want to have fun and use free electricity, as a researcher, I mean, that's I think something that some people do. Let me not get into this, right? So what you do is you add another transaction to this, where you say, to me, the miner, there should be another payment from nowhere, really, of 12.5 Bitcoin. Incidentally, that's going to go down to 6.25 Bitcoin sometimes next year, I think. So, but right now you would get 12.5 Bitcoin if you want to be participating in this. Now, if you can just do this and be done, then lots of people would just say, oh, I want to have some free Bitcoins here too. So it's not quite as easy as this, right? What you then have to do next is combine this with the existing blockchain. So what do I mean by that? There's this blockchain, so that's a public record essentially of all the transactions. And that's actually sort of, you get a version of this. You can sort of check which transaction have been made, right? All the past blocks of transactions, they're here, right? And you want to append this new block of transactions to the existing blocks, all right? Now, if you look at this from a computer science perspective, it's really just a bunch of zeros and ones. In fact, I could turn this PDF document, I could look at the binary code. I could probably, look at how this particular image here is stored. It would just be a sequence of zeros and ones, right? So as far as computers is concerned, this is just a particular sequence of zeros and ones. It's a pretty long sequence typically, but here just gave it the sequence 110101, just as an example. And the existing blockchain will also have, be encoded or can be encoded with some sequence of zeros and ones, right? So some number, right? So there's some number that encodes this, some number that encodes this. And then there's a final thing that the miner has to do. He has to guess a third number, right? So that's what he does here. He guesses another number. Just take a guess. And then he puts that into function. He puts this in a hash function, right? That hash function, that can be, everybody can compute it, it's well known. And he checks whether the result of the hash function gives you a number that's small. It's always going to be larger than 0, but to be smaller than some delta t, right? Where delta t is some number that gets adjusted over time in a specific way, so as to make sure that these blocks are added about every 10 minutes. I mean, that's how, given how many people are guessing solutions here, right? So if you just make one guess, it's very unlikely that you find a guess that satisfies this criterion. But if you guess many times, right, maybe by chance you'll draw upon a number that satisfies this criterion. And if that happens, you get to append this new block of transactions to the old blockchain. The blockchain has been expanded by one more block, and you get the 12.5 Bitcoin. So that's in essence how Bitcoin mining works. That's how you can decentralize it, because anywhere in the entire world, can be mined and try to add his personal version of these transactions to the system, and try to get wealthy doing so. In fact, there's huge activity in all this mining. So this is how this works, right? This is what a blockchain is. This is how you get to this decentralized mining. Okay, so that's all good and fine. So that's a computer science of things. But I'm an economist, and I want to talk about the economic side of things, and I want to talk about the macroeconomic side, monetary side of things. Oops, that's the wrong direction. So I want to talk about prices and quantities, right? I mean, that's what economists talk about. Quantities actually turn out to be quite boring. It's just increasing pretty much at a deterministic pace. It's going to converge to something eventually, but prices are more interesting. Right? So if you look at the Bitcoin price, this is what it has done, right? I actually literally got data to this morning, and I was so proud. And then this afternoon, I heard that Bitcoin fell another $400. So that's unfortunately not part of this plot here, but otherwise it's pretty recent. And so that's the Bitcoin price. Pretty crazy movements, right, if you look at this. And so naturally, this has, been given rise to lots of concerns. And so this brings me up to question one. Given this volatility, can Bitcoin work as a currency even, right? I mean, given these crazy movements, and if so, what are the consequences? And in fact, there's a lot of skepticism on this, right? So the Bank of International Settlement has come out with a statement that you're not going to see signs of that sort, essentially, right? Given the unstable value of cryptocurrencies, it's unlikely that they will serve as medium of exchange. I mean, they were after Bitcoin here in particular because you're seeing these price movements. So is that true, right? I mean, how do we even think about this? How do we think about this price pass? It isn't coming because suddenly a lot of Bitcoins are entering or subtracted from it, because that's deterministic. Something else must be driving these price movements. So, so that's the purpose of this first paper with Linda Schilling that we just published in the Journal of Monetary Economics. If you're interested in the paper, we made sure you can download it for free. So it's open access. So feel free to just download and read it and circulate it and advertise to your friends. We'd be very happy about it. And what we do there, you know, we are economists, we are theoreticians. We wrote down a theoretical model where you can think about, you know, these issues. We constructed a simple, so that's a simple in the title, but a simple in a new model where two currencies compete with each other, but that are intrinsically worthless. I should stress that. I mean, that's, you know, sometimes you see these statements, you know, Bitcoin has no chance of succeeding because it's intrinsically worthless, right? It's costly to create, but unlike a stock where you get dividends, you know, Bitcoins never pay anything, right? So how come that it's trading at a positive price? Well, if you think about the pounds in your wallet, they're also trading at a positive price, right? It's pretty remarkable that you can take your paper currency into a coffee shop and get a latte for it, you know, a piece of cake or something. Right? Why? I mean, it's paper, right? Why should anybody give you stuff for paper? Now, that's a question that monetary economists have, of course, thought about for a long time. Asset pricing theorists are surprised by this, but for monetary economists, that's an old hat. So we're going to have, you know, so money in its very essence is a bubbly asset. It's a bubble. It's a pure bubble because it's intrinsically worthless, but it gets value because it's used as medium of exchange. So that's what we assume here, right? You're having, and I should say there's a bunch of papers out there that somehow make up dividends for Bitcoins. I think that's the wrong way to go. Bitcoin doesn't pay dividends. Pounds don't pay dividends, but they may be useful as medium of exchange. Now, you might argue that right now Bitcoin isn't used as medium of exchange, but, you know, we try to be forward-looking. Suppose it were. Suppose 3 years, 4 years, 10 years down the road, you know, I just heard there's an app that you can download for your Chrome browser so that you can pay with Bitcoin on Amazon. It turns out that you can pay taxes in Ohio with Bitcoin, you know. So I mean, you know, it's used for transactions now here and there. Maybe, you know, maybe it's going to be ubiquitous eventually, right? So that's a world that we envisioned. So we wrote down this model. There are two competing intrinsically worthless currencies serving as medium of exchange. You don't have to use them, right? I mean, you're having both in your pocket, and you're free to, well, one on your app and the other one in your pocket. You're free to choose which one of the two, or maybe you're indifferent between the two. But that's a world that we envisioned. And we got a bunch of results. I want to emphasize this one in particular, but before I do this, let me emphasize 4 and 5, right? So there's a bunch of implications that follow from this. And I think these implications are interesting if you're looking on websites, you know, what people say about Bitcoins, what they say about cryptocurrencies. I mean, there's, you know, there's so many claims out there, right? And this model gives you perspective. You can sort of say, that's, you know, at least from the perspective of the model, that's rubbish and that's not rubbish. For example, we find that the volatility doesn't invalidate the medium of exchange function. So that's counter to what the BIS just said, right? I mean, so that's just, you know, say that's rubbish. And why is that? It is because, you know, Bitcoin may be volatile in price, but you know from asset pricing how to correct price movements so that people get potentially risk premium for holding risky assets. It's not news, right? You just have to make sure that the price process is consistent with any risk premium that people demand. And then you're fine. Then the fact that that is a volatile price process shouldn't affect you in using this medium of exchange. That's essential logic. The other one here is maybe more interesting, and that should concern anybody in central banks, right? You might say, oh, these miners there in China, whatever, they're producing all these Bitcoins. How are they getting financed, right? So if you're a miner, you're getting these 12.5 Bitcoin, and 12.5 Bitcoin is worth something, right? You can buy yourself, I don't know, that's, so am I seeing this right? I think that's about $100,000 worth these days, right? And so you can go out and buy yourself a nice Lamborghini, well, used Lamborghini, let's say. I think Lamborghinis, I don't own a, does anybody own a Lamborghini? Do you know how much? I don't know, whatever. So you can buy yourself a nice car, let's just say, all right? And, but somebody must come up with these resources, right? Is it a tax on the people that hold Bitcoin? You see that sometimes on the internet? And the answer is not true. It turns out to be a tax on the people that hold dollar. So The logic is that the total quantity of money has to be remaining unchanged. So as more Bitcoin are entering, the dollar central bank has no choice but to withdraw dollars from the system or not let it grow as fast. So essentially, it's a tax on the dollar issuing central bank. So in some sense, the Federal Reserve Bank of the United States or the Bank of England are financing the Bitcoin miners. So that's a result of this paper. So I mean, I don't know. If I was a central banker, maybe that should catch your attention. But I want to advertise also this result here. We find that, that we can say something about the price path. And in a special case, it says that the Bitcoin price is a martingale. Now, martingale is a mathematically technical term. It means essentially that the Bitcoin price is a random walk, right? It means that the current price is the best forecast of the price tomorrow, right? So if you have to go on a TV show and they say, oh, you're an expert on Bitcoins, what do you think where the Bitcoin price will be a year from now? You just look at what the Bitcoin price is today and you say 7,500 something. Whatever the current price is. How do I know? Schilling Ulich. That's the answer. So now that's very different, right? Because you're seeing all these internet blogs where they say, oh, it's going to go up to 100,000 and what have you. So that's wildly at odds with this. Now it's a theory paper, right? And you might have this reaction that you say, well, this is a crazy implication. I mean, come on, are you kidding me? When we saw this run up in prices, right? This doesn't look like the current price was a good forecast of the future price, right? We saw this huge, what looks like a bubble and then a crash, right? This is just forget your theory. It's clearly wrong. Okay, so that might be the first reaction that you have. But here I would appeal to you that that's not the fair way to evaluate the theory. I want to appeal to what the physicists have called the anthropic principle. So physicists have this problem that there's I'm not a physicist either, so if there's physicists in the room, I apologize, right? But there is a universal or universe constant that has to be true for 32 digits in a row. Very precise. If there's a slight deviation, the universe would either collapse or expand, life wouldn't be possible. And physicists have written PhD theses and broken their brains. Why is a constant exactly the way it is? Some physicists, I think Libeskind and Stanford and some other people, now argue that's the wrong question to ask. The point is, if the constant wasn't as it was, we wouldn't be here to ask ourselves the question, why is the constant this way? Because life wouldn't be possible. Only if the constant's exactly like this can you have sentient human beings that scratch their heads and say, how come the constant is like this, right? We would call this a sample selection bias, actually, in economics, right? And I think that same is true for the Bitcoin price. If the Bitcoin price had stayed near zero, I wouldn't be giving this talk today, right? I mean, it would be, right? People would say, that's just a failed experiment. At least it wouldn't be interesting to macroeconomists. The fact that it exploded suddenly, generated a lot of interest in people. In fact, I got, Actually, I bought a Bitcoin sometimes here, and then it first fell in price. And then I thought, oh man, I'm an idiot. I bought it at $700-something and was trading at $100. I shouldn't tell my wife. And then eventually I woke up again, and I saw the news. I was trading at $20,000, and I thought, boy, I'm smart. I'm a genius investor, right? Now it's time to tell her. Actually, I still haven't told her, but maybe she probably doesn't care in some sense. So anyways, so I would surmise that the test of the theory started afterwards. And the first time that we issued a working paper version of our paper was in end of March 2018. So precisely the date was 26th of March 2018. So our paper, I would argue, makes a prediction about the future. So this is the price path of Bitcoin since that date until literally today. And if you look at that price path, it kind of look, I mean, I don't do a formal test here, right? But econometricians that have done this or something, this kind of looks like a martingale, right? It hovers around here, right? And then it goes down here, but there's no tendency to return, and it hovers around here and then goes up there. It sort of kind of wanders all over the place without any sense of direction. So, I mean, as far as the theory is concerned, that's for the simple theory, I think this is pretty good news. Okay, so that's paper number one, right? So, I mean, you might remember the current Bitcoin price is the best forecast of future Bitcoin price. That's sort of one insight. The paper gives a slightly more general formula than that. So if you're really into trading that stuff, maybe you should look at that, right? But roughly, right, that's the idea. And that's roughly consistent with this picture, I argue, right? The central banks are paying the miners, right? So that could be interesting. And volatility doesn't rule out its meaning of exchange function. All right. So now in this paper that I just talked about, we have the Bitcoin and dollar working as perfect substitutes that analyze. But then you might say, that's not really right? Maybe with pounds and dollars, I can buy, I don't know, nice screen, right? But with Bitcoin, if I want to, buy drugs or, do other things that maybe the government doesn't like so much, maybe Bitcoin is better. Okay, and so we had this paper here now where we thought that some goods are better to buy with dollars, others better to buy with Bitcoin. So it's a follow-up on our other paper, and we thought about how that works. So the transaction costs of buying goods with dollars, the transaction costs of buying goods with Bitcoin. Different goods have different transaction costs, so that's the situation. And there's an exchange fee between Bitcoin and dollar. So then you get to jazz up this martingale condition. This model here is deterministic because it's a short paper, so we didn't have uncertainty in there. So then saying something is martingale really just says something is constant, right? So martingale, if you don't have any randomness and say the current price is best predictor of the future price, then it means the future price is exactly equal to the current price. You get a constant exchange rate in that case, right? But here, because of these transaction costs, you can have sort of movements in the exchange that are essentially bound by these transaction fees between Bitcoin and dollar. And we go through some examples that can then emerge in that situation. So we have thought about imperfect substitutability. I partly talk about this because this issue may come up again as I talk about the next paper, because there we're going back to perfect substitutability. And it would be very tempting to say, well, what happens with imperfect substitutability? And then I would say, well, probably something like this. All right? So the perfect substitutability case is just a nice benchmark. Okay, so then we had the third question. I should have talked about the three questions at the beginning. I just flashed by you these three slides. They're all sort of monetary macro questions, right? And so the third question that I want to head there has to do with, this whole universe, this whole, cryptocurrency world, right? So the first papers, focused, were very much inspired by Bitcoin, but Bitcoin isn't the only cryptocurrency out there, right? So this is by market capitalization. There's a picture from a few days ago. That's the source where I got this from. This is Bitcoin, right? Here's some few Bitcoin derivatives, Bitcoin Cash and Bitcoin SV. That's, these are forks from the blockchain. I could take that other picture and explain what a fork is, but again, there's not a computer science talk, but it's kind of fascinating. Then there are cryptocurrencies that were developed all on their own, right? There's Ethereum, and Ethereum is an interesting platform too. If you want to issue your own cryptocurrency, you just learn a little bit computer coding, and you can probably do this after this talk in the evening. You have your very own cryptocurrency named after you, right? It's kind of easy to do. And so there's all these cryptocurrency that are issued on Ethereum, for example, lots of them. There's Ripple, there's, Litecoin, there's, all kinds of other things that are trying to address various deficiencies that people have argued, Bitcoin is facing. But as you look at this picture, right, this market capitalization, this is how much the stock of these cryptocurrencies are currently worth. It's true that Bitcoin is now less than half, but it's still the dominant player in this, and that's why everybody so far has been paying largely attention to Bitcoin. Well, this may be about to change because we're getting a new entrant, and that's Libra. So Libra is, to be issued by a consortium led by Facebook, and their financial, players and intermediaries in there, and they want to really make it, globally useful currency, right? Bitcoin might still be nerdy, people might not trust it or whatever, but Libra will be a game changer if that's going to happen. And so there is a blockchain behind it, but only few people are allowed to add blocks, right? Not everybody can just mine and add a block. It's only the people that are part of this consortium that have a permission to add a block. So it's a permission blockchain. They back it by a basket of financial asset, right? So that's also different from Bitcoin. Bitcoin, isn't backed by anything. It's just, whatever people think it's worth. Whereas Libra, the idea is you can exchange it, you can give it back, and you're getting back the underlying assets. or you can give them the value of the underlying assets and get Libra, right? So this consortium stands ready to trade Libra at whatever price they announce, right? And they just have an exchange rate and make sure that basically accounting works out right here. And so I mean, you could think of this, for those economists familiar with this, as a narrow bank, as a money market fund, right? Yeah, money market fund. And in that sense, you could argue there's nothing new here, all right? But in some sense, there's something very new because, I mean, people write check on money market funds, that's true, and they write check on the bank accounts and so forth. But now this is trading as a currency, so transacting these things between people, it feels very different from using your checking account, right? It has a new quality to it. Once people treat it as a currency and no longer as a bank account. And so, they're going to have digital wallets. This should be called Calibra here, sorry about this. And that's sort of one of the concerns. It's going to become automatically part with your Facebook and your WhatsApp, right? And so, will they know your transactions? So the regulatory concerns, will Facebook know what you're doing, right? Will there be money laundering allowed? The regulators don't like this. You can do this with Bitcoin, but obviously this is supposed to be very official and very middle of the road looking, appealing to lots of citizens. So they want to play nice by the regulators, but they're running into all these regulatory hurdles right now. Some of the original members of the consortium have jumped ship, but there's still a lot of members on it, so we'll see. They still plan, I think, to launch it by 2020. You'll see, right? So you can invite me back next year, and then we can talk about it. But for now, there's, I think they're still. I mean, it's wobbly, but I think they're still on the road to do this. If they do this, there's a good chance it's going to be much larger than Bitcoin, and it's going to be large. And I think that's also why it has attracted all this regulatory attention. Bitcoin, you could say, well, that's a toy for some computer science nerds, right? This one is serious, all right? And if it isn't Libra, then, I don't know, Walmart is going to issue a coin, or Amazon, somebody's going to do this, right? If you have learned one thing from technology, if something is technologically feasible, it gets done, right? And so this is so easy to do that, I mean, the idea is, obvious that I think it's going to get done. All right. So that brings me then to a third question, right? Libra will be, everybody in the world uses Facebook, so this is going to be a globally circulating currency. And Bitcoin, you could argue, is also already a globally circulating currency, right? And so one way or the other, we may be heading to a future world where we see a globally circulating currency, maybe cryptocurrency, competing with the national currencies. And, and there may be, so what are the implications? What are the monetary policy implications? Right? As a monetary economist, as a macroeconomist, that's a question to me. I mean, there may be other questions, exactly how I set up the computer code and so forth, regulatory concerns, but I leave that to my micro colleagues or the computer scientists. Okay, so that brings me to this paper then, right, which is the title of the talk. So let me talk about this. And I brought way more slides than I can present in the remaining 50 minutes, but let me see how much I can get across from here. So this new paper, fresh off the press, right? We finished this end of August, and we're trying to advertise this now a little bit, right? You can download this from SSRN. I think lots of people already have, and it's joint work with Pierpaolo Benigno and again, Linda Schilling. All right. And so the question, the issues that we have, right, I mean, as I just described, and you can see, right, from the slides, different slides now. Now I'm getting into the academic part of the talk here, right, but still a little bit introduction. So, if you only have national currencies, right, people have thought about this, right? If you have only national currencies and exchange rates between them, are there any restrictions that emerge? And there are restrictions that emerge, and they are known as, Mundell and Fleming have thought about this, so I'm going to tell you what they are, right? But with a global currency, right, you get sort of additional phenomena. You get a global medium of exchange. The global currency will compete locally with the national currencies. And then sort of via this vehicle of the global currency, you get sort of transnational competition between the national currencies. Okay, so that's where I'm heading. That's the central idea of this paper, and I'm gonna show you how that works in a moment. Okay, so the question that we then after is, what are the monetary policy implications of introducing global currencies? If we didn't have global currencies, if we just had national currencies, we would be in this Mundell-Fleming world. And we would be in this world where the impossible trinity rules. So Mundell and Fleming thought about 3 policy objectives that you might want to have. You know, let's have free markets, maybe let's have a fixed exchange rate, and let's have independent monetary policy. Mundell and Fleming have argued you can't have all 3 at the same time. One of them has to give. So we're going to maintain free capital markets in all of what I do, right? If you don't have free capital markets, then you know what does it mean to be global, right? So with free capital markets, you can both have independent monetary policy and a fixed exchange rate. But you can at least, you know, you can pick your poison, right? You can at least have one of the 2, and then you can't have the other one. Now here, when we have free capital flows and a global currency circulating alongside national currencies, what we claim is that there will be additional restrictions. What we find is that if the global currency is circulating globally, the interest rates of the 2 central banks become equalized. So they become the monetary policy become synchronized. We call this, you know, so Linda felt that, you know, Marcus Brunnermeier is always very good in putting labels on things, and then, you know, everybody talks about, I don't know, whatever, SPs and so. So here's our abbreviation, right? So this is our attempt at being, you know, Marcus, right? So we call this the crypto-enforced monetary policy synchronization. So I hope you all blog and use that, you know, use that label, and then becomes very popular. I mean, who knows, right? So crypto-enforced monetary policy synchronization because you have these interest rates being equalized. And as a result, exchange rates between the 2 national currencies now become a martingale. Now we can escape from that as a central bank, right? It's not like your hands are tied here, but the escapes are unpleasant in some sense. You can either escape towards a zero lower bound, and we have been there, and some countries are still there, so that doesn't seem very attractive. Or you can escape to the other side, but that means you're rendering your own national currency useless, right? Nobody's going to use it anymore. So that would be terrible. So and if you have something like Libra circulating, then there are additional restrictions that arise from this. So Libra imposes some additional restrictions on monetary policy that I hope I will be able to show you. So the impossible trinity becomes even more impossible in some sense. Okay, so it's a framework. So there's a bunch of papers here related to this. One person that I want to emphasize, maybe Hayek. Hayek used to be, you know, just across the street here at the London School of Economics, where my colleague and friend Albert Ritschl works, for example. And Hayek sort of had a book on private currency. So people have thought about these issues before. But back then, you know, maybe it didn't seem like such a plausible thing to do. But nowadays, I mean, as I said, you can issue your private currency, you know, this evening. You know, just learn a little bit of computer language, get on Ethereum, and off you go. Right? It's easy to do, and as we have seen, you know, many people do this now. All right, and then there's a bunch more papers here that are in this spirit. Okay, so here the framework, we try to strip it down. Okay, so the paper is a how shall I say this? It's a striptease, right? We started with a complicated model. Then do we need this now? Do we need this now? I mean, if we stripped it down to the bare essence, right, and then try to draw conclusions from this. Okay, so what are we going to have? We're going to have, you know, time. You have to have dynamics, right? Because people accept the currency, they need to spend in the future. We figure we need many periods here. We're going to have 2 countries, right? Then you have national currencies in both. We're going to have 3 currencies, so home, foreign, and global, H, F, and G. If you want to give these things names, and since I sometimes give the talk in the US, sometimes in the UK, sometimes in Europe, I make the home currency always $1 and the foreign currency in yen. If I ever give this talk in Japan, then I probably have to change that one. But you know, so far I'm safe. All right. And the global currency, think of that as Libra or Bitcoin, if you like. Now, here's sort of an ingredient familiar to the economists, you know, to the economists in the room, to the researchers. So I'm going to have a nominal stochastic discount factor in each country. I'm going to show you what that is and how it's useful, and from there we derive implications. So this is something that's often done in these models. So that's not our invention, very conventional. It comes out of many models. We're going to have free capital markets. We're going to have the central bank set the nominal interest rates in each country. And here's sort of a new feature, the way we formulate it. Money offers liquidity services. So that's like bringing in a dividend through the back door in some sense, right? But if you write down models that explicitly account for people holding money for transaction purposes, then you can derive the equation that we're using here from a more full-fledged model. So this encompasses a bunch of models. In the paper we go through how that's done. Okay, so here's now I'm starting with equations. Okay, so there's a stochastic discount factor in the home country, and there's a stochastic discount factor with a star in the foreign country. What are these stochastic discount factors for? The stochastic discount factors serve to discount, that's why they're called discount factors, future returns on an asset. So if you have an asset that's denominated in the home currency and has a return RT plus 1 between T and T plus 1, then it has to hold that 1 is equal to the conditional expectation at time T, so you take into account all the information you have at time T, of the product between the stochastic discount factor and that return. That's the Lucas asset pricing equation. So that's super standard in finance and lots of macro. And likewise, if you have an asset that pays off in yen, right, you have that equation there. So these are the two pricing equations. In particular, we can take a safe bond, right? So a safe bond will return interest rate IT or IT star if it's in yen, and then 1 plus IT or 1 plus IT star will be RT, and then, because it's already known in time T, we can divide through this, and then you get that 1 over 1 plus IT is just the conditional expectation of these stochastic discount factors. So that's where the central banks come in. And you can derive some implications from this. Let me skip that slide, right, in the interest of time. Let me go here. So the next element that we need in our framework, and that's in essence really the new piece here in the analysis that I haven't seen formulated in a sort of abstract generality, is that money offers liquidity services. So if you use 1 unit of H, $1 at home, you're getting LT units of liquidity services. I'm gonna say in a moment what that means, right? Where that shows up in the equations. But if you use, $2, you're getting 2 units of liquidity service. If you use $3, you're getting 3 units of liquidity service, right? So it scales for the number of dollars that you're using. More dollars, you're getting more liquidity services, all right? And then therefore, if you use one of the global currencies, you're getting LT times QT, where QT is the price of the global currency. If the global currency trades at $3 per unit, then you're indifferent between having $3 or 1 unit of the global currency. You're getting LT times 3 in terms of liquidity services. So that's what we hardwire in there, this linearity. And likewise abroad you're getting LT star units of liquidity service if you use a yen there, and you're getting LT star times QT star. So QT is the price of the global currency in yen in terms of liquidity service abroad. Okay, so what does that mean, liquidity services? It means it shows up in the asset pricing equation as follows. We know that currency has a lower nominal interest rate than bonds, or it should have, at least if you're not at the zero lower bound. And why would that be? Well, it is because money is used for making purchases, right? So it has to somehow show up in these asset pricing equations. And that's what this means, right? So for you to be happy to hold the dollar from one period to the next, right? You're essentially collecting the liquidity service. This kind of looks like a dividend almost here. And then you're getting repaid $1 tomorrow, right? The normal return on holding a dollar is $1 tomorrow, right? You just, the return here, the RT plus 1 is just 1, because you just taking $1, you get $1 back. That's all that's happening. But you're also getting these liquidity services here. But you wouldn't be happy to hold it, right, if the price is too high, right? So for example here, if you multiply this through with QT for the global currency, if QT today is higher than the liquidity services that you would get, which is LT times QT plus the expected payoff of the cryptocurrency tomorrow, which then is MT plus 1, QT plus 1, you don't want to hold it. You don't want to use it for transaction purposes. It's too expensive. It would, if the price is very high compared to the price tomorrow, it's too expensive to hold as a medium of exchange. So only if you have equality here would you consider it as using it as medium of exchange. If there's a strict inequality, that means the global currency is out. I mean, there's a choice here, but both can be used. Same thing for the foreign. Okay. So now, so here's a model how you can derive this all. So a bunch more black ink, right? So let me not get into all of this. Very beautiful. Trust me, I can derive this from a larger model. And let me, and there's extensions there. So here's a satellite perspective on what's happening. I was thinking of calling this bird's eye perspective, but then we're global, right? So I have to go to satellite perspective here. Right? That's the advantage of being macroeconomists, right? You're having home country, you're having a foreign country. There's a home currency circulating here, the foreign currency circulating here, but the global currency is kind of circulating in both. And there will be nominal interest rates between two periods, home and foreign. There will be exchange rates between these two currencies, and there will be the price of the global currency. Okay, so then what we're finding is this here. So this is the proposition that I essentially announced. Oops, is this still working? Yes. That was a proposition that I announced early on. Suppose, right, so we're looking at a situation, we're looking at an equilibrium where we suppose the national currencies are circulating in both countries. We suppose that the global currency is valued. I mean, otherwise would be not interesting, right? If it's not worth anything, then what's the point of writing this paper? And suppose the global currency is used in both currencies. So that's a big if, but suppose that's the case. Then we can show the nominal interest rates on the bonds have to be equal, the liquidity services have to be equal, and the nominal exchange has to be a risk-adjusted martingale between the home and the foreign currency. And the logic is really coming from here. If the global currency is used in both countries, it must be offering the same liquidity services. And because it's offering the same liquidity services, that enforces that the stochastic discount factor have to be the same in expectation, and that means the interest rates have to be the same. So that's a short version of the proof. I don't have the time to go through the proof, but you get this synchronization. What are the escape hatches? So, maybe the home central bank could lower its interest rate relative to the foreign central bank, or it could raise it relative to the foreign central bank, right? I mean, why not, if you find yourself in this enforced synchronization or enforced monetary union, imagine the UK's forced monetary union with the EMU, right? I mean, that would be horrible, right? I mean, depending on which politician you listen to these days, right? You want to get out of this, right? So what are the options for the Bank of England, let's say, to get away from this enforced monetary policy synchronization with the ECB, if that's the issue here? Well, what happens if they lower it? Well, you can do it, right? And so we take the same assumptions, but we don't insist that the global currency is used in both countries. If you lower your nominal interest rate below that of the foreign interest rate, then indeed, now the global currency is too expensive to be used as a medium of exchange at home. This one equation that I showed you that has a big or equal in there becomes a strictly bigger. Global currency is not circulating at home. Libra wouldn't be used in the UK in that case, and only the home currency is used at home. And you can say some things about the exchange rate too. Sounds great, but there's going to be but to this in just a moment, right? So if you lower your nominal interest rate compared to the other central bank, you can get rid of the global currency at home, right? It's circulating in the other countries, but not in your country, and you kind of regain some independence for your monetary policy. The other direction is worse, though, right? So suppose we know that the global currency is used abroad. Okay, suppose we insist on this, and now you raise your nominal interest rates at home. Now this inequality that I showed you for the global currency turns into an inequality on the national currency. I mean, the more general case has also an inequality there. Now the national currency is too expensive to use at home, right? It's sort of the flip side of the argument that I just gave in the previous case. And what happens then is that the national currency is abandoned. So as the Bank of England would try to raise its nominal interest rates above that of the ECB, nobody wants to use a pound anymore. Everybody would be transacting in Libra in the UK. Now, so in terms of these questions here, right, if the home central bank lowers its interest rates below that of the foreign central bank or raises interest rate above that of the central bank, well, if it lowers this, and if both central banks are trying to do this now, you could sort of extend this result a little bit and speculate what happens if they're both trying to do this. One central bank tries, we don't like the Libra, right? We're going to be lower than the other central bank. We don't like it either. They're also going to lower. Where do they end up? They both end up being stuck at the zero lower bound. They both have it at zero, and Libra is circulating nonetheless, right? So it's a doomed race, right? I mean, they both race to the bottom, and then they're stuck at the zero lower bound. That's not attractive, right? And raising the interest rate, if you want to, and the central banks don't like to abandon their home currency. I mean, that would be bad news too. So the escape options are there. They're just not very attractive. If on top of that, so that's the So I'm sorry for racing through the results here. So this goes very quickly. How much should I say about this one here? So, maybe I advertise a paper if you want to go to this. So we thought about the Libra case too, right? So the Libra is issued by a consortium. They have these assets backing up the Libra coin, and they stand ready to buy and sell the Libra at a particular price in dollar or a particular price in yen. Now, in order for this, to make the regulatories happy, right, it must be the case that they're not making profits beyond some fee, right? They probably announce, we're going to charge the following fee for doing this, right? I don't know, 0.5% or something. And then, and other than that, right, our accounts have to balance, right? I mean, you can't have more of these Libra coins circulating than you have assets, right? Then you would be underfunded. And if you have more assets than Libra coins, you should just take it out as profits. So there's a condition that says your accounts are balanced, and if you look at that condition carefully, it would be this condition here. The Libra price tomorrow, QT plus 1, will be 1 plus the nominal interest rate minus the fee you're charging on the service on the price today. And if you just stare at that equation, you can see one thing sort of right away. If the nominal interest rate is higher than phi t, that means that the Libra coin will go up in price over time in terms of dollars. But if the Libra coin goes up in price over time, it's more attractive than holding the dollar, right? So if that were to happen, if it was strictly bigger than phi t, right, then why would you hold the dollar? You can do the transaction with Libra, and you get a price rise on top of that, right? So central banks don't want to be strictly bigger than this. So this is a new constraint that arises from this. So this is the nature of the next theorem here. With asset-backed currency, if phi t is smaller than IT, then the dollar becomes too expensive. You're getting sort of an additional bang for the buck by going for Libra. Everybody's holding Libra, and you're abandoning your home currency. Now, phi t is a small transaction fee. If that's 1% or 0.5%, we're talking about very small nominal interest rates here. Right? So the bounds, the bound that the central bank cannot exceed is very, very small indeed. Now, if they're both equal, then both can coexist at the same time. Or if the nominal interest rate is even smaller than the fee, then only the home currency is circling at home, right? I mean, but this is like the escape hatch down, right? There is not much maneuvering room here, right? So, I mean, the nominal interest rate could be 0.3%, but that's not much to talk about. So I think this, from a monetary policy perspective, what the simple model shows here is that things could become very constrained. It could become a serious constraint in monetary policy throughout the world if Libra starts to be successful in circulating as a global currency. So that's sort of the implication of this here. And the simple model leaves out lots of things, but it offers a framework to think about these things. And you could be happy with that situation or not happy with that situation. So we don't make a normative statement here, but that's the insight. Okay, so. Right, so let me conclude here. I think I'm already 5 minutes over my allotted time, right? What are the monetary policy implications of introducing a global currency? You may have a déjà vu because you've seen the slide before. I just copied and pasted it from the previous slide. It's exactly the same slide. So if we didn't have a global currency, right, we would have Mundell-Fleming, impossible trinity, free capital flows, means that either you have independent monetary policy or you have a pegged exchange rate. You can't have both at the same time. But with a global currency, like maybe Libra, but could also be Bitcoin or something, if that's circulating globally, right, then you either get this crypto-enforced monetary policy synchronization, or you're getting these very unpleasant escape hatches, racing either to the zero lower bound or banning your own national currency. And with a currency like Libra, then you get these additional restrictions. All right, thank you very much. That's all.
So Professor Uhlig has kindly agreed to answer questions on his talk, and I can certainly think of one or two, but first question from the back, please. And please use the microphones when you ask your question.
Fascinating stuff as always from you. What you do here looks to a monetary historian very much like the no arbitrage condition from bimetallism, when you have two currencies. And what you have here, the boundary conditions that you have look a little bit like Gresham's law, but just an inverse version of it. Mm-hmm. So what you may want to do is look up what Marc Flandreau at Penn has written about no arbitrage in in the bimetallic system, or what you have in Sargent Valley. It's really very similar. One worry I have is that what you do is actually also applicable to reserve currencies, and might totally independently of the Bitcoin problem. But that much of what you say might be holding independently of the Bitcoin problem.
Sure, right. Yeah.
If you replace home and foreign with euro and sterling, and the global currency is the dollar, then perhaps quite a few of your ideas might carry over. But that's a different thing. But anyway, look at bimetallism. It's really very similar. It's almost isomorphic.
No, I'm totally sympathetic to this comment, and that's also, I mean, I'm stressing the cryptocurrency application here because I think, in some sense, it's I feel there's a qualitative change in the way these currencies are used. But I mean, one could also say that in some ways it's reminiscent of things we have seen before, right? These exchange results that we get here, I mean, we draw on Carrick and Wallace, and Manuel Peck. But yeah, there's been quite a literature that has thought about, what are the implications of coexistence of monies, and we find that here too. There is a slight difference to Gresham's law. Let me just point that out, because the currencies here are fiat, right? So maybe with Libra you could argue it's not fiat, but normally you have these results that silver coins will drive out gold coins because people prefer to hold gold coins. Why? Because gold you can melt and make a ring out of it or something. But Bitcoin and dollar you can't melt down, right? So the typical Gresham law logic doesn't immediately apply, right? So there's a bit of a step. But I agree that there's a lot of, in spirits it's very related to that literature. And you're also right, one could also write, the global currency as a dollar, right? So if the dollar is circulating globally and you're having, countries in Africa or something, then you would have the same synchronization. And we're seeing sometimes that, but the question is the dollar physically circulating, right? So many countries that have dollarization, it's really only that people post prices in dollar. It's still that the own currency is circulating. So that's not what we have in mind. What we literally have in mind is that it's used as medium of exchange, right? And then, you could argue that, okay, to the degree that everybody has a credit card that runs on dollar, right, then maybe, or that couldn't run on dollar or the national currency, then you can also use a dollar globally, right? I mean, it's true that if you can go to any country in the world, have your credit card run on dollar and pay for it, right? But Visa charges a fee and so forth, right? It's similar in some ways, but I would argue that with cryptocurrency we get it has a new quality to it. But exactly what's new and what's old, it's a fair question. Yeah.
Please, there was another question from further forward on this. Please, yes.
I know that you have said you haven't provided...
Microphone, please.
Sorry. Normative analysis, this is clearly a positive analysis, but looking at a framework such as this where there are so many negatives attached to it, a natural question is what would be the policy implication? I could think of if we had this many negatives in any other macro kind of list of options, one would think that would policymakers restrict the possibility of these kind of currencies?
I mean, you can see them fighting Libra, right? And they put forth regulatory concern, but I wouldn't be surprised if they are, deep down scared of the competition. And I don't know. Everybody. So I just give you my thoughts. I mean, again, we haven't analyzed this, right? But personally, I like competition, right? And personally, I don't like the government to be the monopolist of things, right? I mean, the French government had a monopoly on video telephones for a while, and I'm not sure that, and they had a monopoly on telephony. And so once we gave up, once we allowed sort of private competition to these sectors, we had technological progress, right? And these cryptocurrencies offer technological possibilities that I haven't talked about here at all, right? Things like smart contracts, settlement issues and so forth that are truly fascinating. And allowing that kind of competition privately would drive technological advance, technological progress, right? And so it's maybe we should ask ourselves whether we truly want central bank to be in charge of currencies if you can issue them privately and if that's a better technology, right? So it's, the central banks may not like it, right? I mean, they're out of a job, but they often pay me well, so they're good friends of mine, so I feel sorry for them. But other than that, maybe competition is good.
Okay, well, thank you.
So
question. Was there a question over there, please?
Central banks will not like
Can
it.
you switch on them? There's a button that should light up red. Yes.
You said the central banks will not like it, but the amount of synergies that they make out of issuing currencies is part of the government's funds.
Right.
So will it not have a very bad impact if the cryptocurrencies take over the centrally issued currencies? That's one. Secondly, cryptocurrencies are decentralized currencies. Now, many are decentralized currencies,
Yeah.
but many central banks are planning to come out with their own digital currencies.
Right.
What will be the impact? So these
Yeah.
are
No, these are both great questions. So the first one is, if you can make your own currency, that's actually a very profitable thing to do, right? I mean, you take paper and you write your signature on it, and then suddenly it's worth something, right? I mean, isn't that magic? So I mean, it's a fantastic thing, and of course, government likes to keep that for themselves, right? Now it turns out that there are many papers out there who have argued, well, the cost of producing currency is zero, right? The private cost of holding money is, say, the nominal interest rate of the seigniorage that has to be paid to the government, and that's inefficient. So the best thing to do is to actually make that zero, to make the private cost of holding money zero as well, to make that equal to the social cost of producing money, right? That's the Friedman rule, right? So the Friedman principle, the Friedman rule always, in many of these papers, comes up with a prescription. You should have the nominal interest rate at zero. I mean, that's right. Now you can, and there are better ways of raising taxes than through seigniorage. I mean, there are also some papers that come to the opposite conclusion, but, I would say 90% of the papers in the monetary policy world that think about optimal monetary policy always seem to come down to the Friedman rule and say, you should be close to nominal interest rate of zero or collect very little seigniorage in effect, right? And so now we have seen the zero low bound, we don't like it, right? So that's maybe the drawback of this argument. We still have to think about exactly, how does it contrast with this Friedman argument. But if you're on the side of the Friedman argument, which again, many of the theoretical analysis deliver, then you could argue that the Libra competition forces central banks, right, to be more efficient, right, to not squeeze out so much profits from private citizens in running a central bank, right, and they shouldn't in some ways, right. I mean, that's what we learned from this literature. So I mean, so it's true, it's hampering taxing possibilities for the government, but again, there may be better ways of raising taxes through this.
could worsen for many countries probably.
Pardon?
Even the fiscal deficit position could worsen for many countries because many governments depend, including my own country,
Right.
depends on central banks.
Yeah, no, I mean that's, I agree. I mean, I think, sometimes when we look at hyperinflations, I mean, the reason they often come about is because the government is desperate, right? And seigniorage is the only way of how to raise fiscal revenues. It's true, these countries will be even more in a bind, right? And the easy advice is, okay, have a good tax system, right? But that's easier said than done. I mean, I'm certainly sympathetic to the point. A country that has to rely on seigniorage as the only way of collecting revenue might be stuck in that situation. That's for sure. The second thing that you asked is about the decentralized nature of right.
Central bank digital currency.
Yeah, central bank digital currency. Right. So this is a new area. So I think Sweden is going that way, and some other countries are going that well full force. I expect that once we see this working well in some countries, right, that other central banks will follow suit, right. So I wouldn't be surprised that 10 years from now, people practically don't have cash in the money.
Probably Venezuela, some South American countries didn't probably fail.
But
They had some
yeah.
not sure.
No, I mean, it's happening here and there, right? But it's gathering steam. Central banks are very interested in issuing their own version of, centralized, central bank digital currency, and will be permission blockchain, perhaps in the sense that only the central bank is allowed to keep track of the accounts, right? So all the transactions might then go to the central bank, or maybe they find some other technological solution. So it's going to be centralized rather than decentralized. But Libra is also rather centralized in that sense, right? So it's somewhere even more centralized, you could argue. But that's where I come back to the competition argument, right? I mean, once you have a central bank digital currency and privately issued digital currency, and because digital currencies can do more than just being a means of payment, kind of like I used to grow up in a time when a telephone, the only thing you could do with a telephone is make a call, right? I mean, nowadays people practically don't use the telephone anymore for making calls. They're doing this for computation, checking the weather and so forth, right? So now if central banks have the idea that the reason people want to hold central bank digital currency is to make payments, right? They may find themselves in a bind very quickly because digital currencies will offer many, many more services, kind of the way phones offer more services. And that's, I think we're going to see that world developing very quickly over the next 10 years.
Okay, any further questions, please? Well, can I abuse my position and ask a question? You mentioned that the state of Ohio is allowing people to pay taxes in Bitcoin. But what would the implications of your analysis be if you happen to live in a country that refuses to accept or global digital currency in payment of tax and insists on that you use national currency?
Yeah, so here, you know, the currency are perfect substitutes for anything, right? So I would probably go back to my AA papers and proceed in the second paper that I mentioned where there's imperfect substitutability. So there would be such a thing as a tax good or a tax bill, right? I mean, you have to pay your taxes. You could only pay that with dollars. You can't pay that with Bitcoin, let's say, right? But you can pay for other goods with Bitcoin or with Libra, right? And then the exchange rate implications from there. So, I mean, I know some people argue that the only reason that currencies have a value is because you can pay taxes with it, but that may not. But you can also argue that that's not true. The only reason that currencies have value is because it's a transactional value, and if you're in the latter camp, then I don't think there's a problem if the government refuses to get its taxes paid in the global currency, but it would mean that the national currency is still circulating, right? So even in these situations that you have here, right, where the national currency is driven out, at least at the last moment when you have to pay the government, you have to convert your currency, you have to convert your cryptocurrency back into the national currency to pay the government with taxes. But you might be in a situation, we haven't done the analysis, but I think if the central bank is unwise and otherwise drives out the national currency, you might be in a situation where the global currency, where the national currency is only used for paying taxes and that's it, right? Whereas Libra is used for everything else.
Yes.
So it's,
Okay. No. Any further questions?
Yes,
Sorry.
One
Oh,
quick
please.
question.
Mhm.
I wonder whether, considering the benefits and costs of cryptocurrencies, benefits being obviously the benefits arising from competition, liquidity services, costs coming from losing your domestic currency, as well as being pushed to the zero lower bound, whether you would want to have a welfare analysis where you weigh the two and come up with prescriptions maybe?
No, I mean, I think that's a great research question, right? So thank you very much. So maybe we're going to pursue this next, or if somebody else wants to. I think it's a fantastic question. And I mean, I should also point out that, of course, this model here is, you know, I mean, super stark, right, in its implication, right? I mean, one can sort of throw lots of monkey wrenches in other places here and there, right? I mean, so it's a black and white picture in some sense, right? And so as we go forward and thinking more about these issues, we probably want to have a more nuanced perspective. But then we also want to, you know, think about wealth implications. The framework that we have written down here, because it's so stripped down, right? We only have the stochastic discount factor. We are not, you know, there's no way we can ask wealth equations. But you can write down more full-fledged models and then start asking these questions. And I think those would be interesting. But then, you know, you want to have other features in there. I don't know, sticky prices. How about that one? So.
Well, that's certainly given us a great deal to think about and, you know, raised plenty more questions, which you will have the opportunity to ask Professor Uhlich because we have drinks just behind the lecture theatre. But could we thank Professor Uhlich for an absolutely fascinating, you know, lecture on a topic which is only going to become more important.
Thank you.